Hey, good morning, options traders. Well, a good question that comes up a lot these days in these markets is, should you exercise a put option early? I've talked about exercising call options earlier in different videos, but it's not often talked about as to whether you should exercise a put option early, and how do you make those decisions? Well, it's a good question. And first off, understand that exercising options early is not always a super easy decision. You exercise calls only for dividends. That is the only time it's going to be advantageous to exercise a call option early. However, that decision is tricky. Just because a stock is about to pay a dividend is not an automatic trigger point to say that you should exercise early. I'm just saying that would be the only condition under which it might be okay to exercise early. Now, fortunately, exercising puts early is a fairly easy decision. But I want to make it very clear for this video, this is not the same as closing your put, meaning that you just bought a put by itself, it's in the money, it's making a nice profit. Should you close it early? That's a different decision. I am talking about exercising, which means that you have 100 shares of stock, you've got the put, and you're trying to decide if you should exercise that put and get rid of your shares early. If you do that, the only benefit is the interest earned. That's it. And that's really what the whole decision comes down to. So, for example, let's say that you own 100 shares of Microsoft trading for $210. And to protect those shares, you buy a 90-day $200 put. So that gives you the right to exercise at any time, put your shares over to another trader, and receive that strike price or $20,000 cash. So that's important to understand. You can do that at any time. But now let's say that Microsoft drops to $190 after 60 days. So you've still got 30 days left on your put. Should you exercise that put early? Well, if you do, you're going to receive the $20,000 cash early. In other words, you're receiving it today instead of 30 days from now. So what's that going to do? Well, that cash is going to sweep into your money market, and let's just say that the money market earns interest of 1%. Now, by today's standards, it's going to be more like 0.01%. It's going to be virtually zero, but just to try and put some numbers on the board, I'm going to at least give the brokers the benefit of the doubt and say it's 1%. How much interest are we talking about here? Well, your $20,000 times 1% is $200 a year, but we're only holding it for 1/12 of a year, for 1 month or 30 days. So that's going to come up to $17. Actually, $16.67 for those of you who are pulling out the calculators and checking it, but let's just call it 17 bucks. Now, it's interesting that to exercise early, that the cost of the put doesn't enter the decision. So it doesn't matter if you paid 10 cents for this put, $2, $10, that doesn't enter the decision to exercise early. Why? Because it's a sunk cost. It doesn't matter. That's something in the past. You are going to lose that cost whether the stock goes to zero or whether the option expires worthless. So we don't need to look and say, well, how much did I pay for the put? That just simply doesn't matter. The question is it worth it to exercise early so that I'm better off by $17? So here's kind of a graphical look at it. Let's say that this is our timeline, and if you exercise today, you receive $20,000 cash. What's going to happen? 30 days later, you will have $20,017 sitting in your money market. And that's for the 17 bucks you're going to earn for those 30 days. Okay, that's fine, but if you had waited until expiration and exercised, you would have had $20,000. So again, now it's really easy to see that the only thing that we're talking about here is the $17. Now, sometimes traders will say, okay, well, 17 bucks is 17 bucks. Might as well exercise early. Well, hold on a minute, because there is a trade-off. What if the stock rises above the strike? What if Microsoft is 205 between now and those 30 days? And yeah, if that happens, the put will expire worthless, but now you could sell your shares for the market price of $20,500. So now the question is, would you rather have 500 bucks versus the $17 you got from exercising early? See, this is the big, I don't want to call it a risk because it's not really losing money, but it's an opportunity cost because you're potentially missing out on money if that stock price rises above the strike. So another way we could look at it is that your break even is the strike of 200 plus the 17 bucks, or 200.17. So if you think the stock has a decent chance of getting above 200.17, you're probably better off holding the shares and the put. So another way to look at it is if there is any chance for the stock to rise above the strike, don't exercise your put early. Now, a way that we can find this technically is that you can exercise if the put delta is -1. And that's just saying that this option has gone so deep in the money that mathematically it's kind of reached the point of no return. It's just not going to get above that strike. But if you have a delta of 60 or 70, yeah, it might be unlikely, but it's not impossible. And you're better off just holding the shares and the put and hoping for the best. So here's another way to look at it, is that if you exercise early, that green line is your $20,017. And of course, that value doesn't change as the stock price changes, just a flat line. But if you hold on to your shares and the put, this is what your graph looks like. Notice that if the stock price never gets above this strike, this red line sits just a little bit lower than the green. That's the $17 you're missing out on. But for practical purposes, you can see there's just not a very big difference between that red and green line. Certainly nothing worth talking about. But look at the difference over here. If that stock price gets above the strike, you're missing out on this angled portion right here, all of this potential money. So this is a good graphical look at this decision. Is it worth giving up this possibility of all of this potential money in exchange for grabbing $17 for sure? So again, in today's zero interest rate environment, the decision is almost automatic. Don't exercise your puts early to get rid of your shares. Just hang on to them and hope for the best. But should we ever start to see environments where interest rates are 2 or 3%, 5%, and you're talking about a large number of contracts and or expensive stocks, then you'll want to check this calculation. But remember, another easy way to determine it is probably not best to exercise unless that put delta is -1. So I hope this has helped you to make some decisions for any of you who are holding shares of stock and put options in these volatile markets. The idea is, for the most part, you should not exercise them early, and by today's standards, because your interest rates are 0, and that would be the only reason for exercising early. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsa2z.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.